In this video, we're breaking down a fractal model setup that formed after a rejection from a higher time frame fair value gap, and how that led to a continuation move lower. We'll start with the 4-hour context and then zoom into the execution time frame where the fractal model confirms the move. Higher time frame context. Starting with the 4-hour chart, price trades into a clearly defined fair value gap which sits above the current price, as we can see right here. This area represents an inefficiency left behind during a previous downside expansion, and it's a common area where price may retrace into before continuing lower. As price trades into this zone, we begin to see a rejection forming at the highs, indicating that the market is not accepting higher prices within this area. This creates the foundation for a potential continuation lower. As you can see, we only have a wick that prints through the fair value gap, but all the bodies start to close below it, and eventually we expand lower. The key here is not just that price reaches the fair value gap, but that it feels sustained above it. Instead of breaking higher, the market shows rejection, which just suggests that this area is being used for a distribution lower, rather than in a complete reversal. The key takeaway, the higher time fair value gap acts as a form of resistance. Once that rejection begins to form on the higher time frame, we can shift to the lower time frame to look for a confirmation through a fractal model. On the lower time frame, price forms a short-term high, creating a local liquidity pool above the price level, as you can see here in C1. The market then trades slightly higher, taking that liquidity pool before reversing. As you can see right here, the market takes the liquidity pool from the C1 candle right there. So first we have C1, and this first move establishes the initial liquidity pool. Then we have the C2 candle that creates the valid shift in delivery, shift in order flow with the change in state of delivery right there. And then we have the C3 candle that expands away from the C2 candle and the C4 continuation. So once price rejects again, momentum starts to shift and the market starts to expand lower, confirming the move. And now at C4, we have the final phase, which delivers the continuation move lower. For the entry logic, usually the entry can be found in the C3 or C4 candle, with a continuation move or continuation type entry in both candles. The downside objective also aligns with the next pool of sell-side liquidity, in this case also with the standard deviation projection from the fractal model. As you can see here, we have the -2 level that aligns with this liquidity pool down here, and we have the -1 level that aligns with the liquidity pool down there. So yeah, after the model completes, the market starts to expand cleanly lower, delivering the expected continuation move. An important part to highlight at the reversal is this SMT divergence with Ethereum. So this means Ethereum made a lower high and did not rate this high, while Bitcoin did, and therefore we have a cracking correlation. The key takeaway from the setup is how higher time frame reaction leads into a lower time frame confirmation. So to summarize, the price trades into a 4-hour fair value gap, shows a clear rejection, forms a fractal model on the lower time frame, and then starts to continue lower. This is a strong example of how the fractal model can be used not just for reversals, but also for continuation setups following higher time frame reactions. If you'd like to explore the fractal model in more detail, the full documentation and resources are available below. And if you found this breakdown useful, consider subscribing for more structured trade analysis. And if you want to learn more, make sure to join the Discord down below.